Today's crypto news, July 29th. Today's the big one. The Fed makes its rate decision in just a few hours, and even now, nobody's fully sure which way it goes. Welcome back to your daily crypto podcast. Today, we're not just covering what happened, we're covering why it actually matters for your portfolio. Let's get into it. Bitcoin's hovering around $64,000 heading into the FOMC meeting after briefly dipping below $63,000 earlier this week. Normally, by this point in the cycle, markets are almost fully priced for one outcome. Not this time. The CME's tool puts the odds of a surprise rate hike at around 35%, an unusually high level of uncertainty this late in the process. Here's the part worth actually understanding. Bitcoin's fear gauge, a 30-day volatility index called BVIV, is sitting well below the highs we saw during past sell-offs. In plain terms, that index measures how much traders are paying to insure against big price swings. Low readings mean traders aren't bracing for chaos. And there's a real pattern behind that calm. Twice in the past week, Bitcoin shrugged off brutal sell-offs in AI and chip stocks, including a historic 2-day 17% crash in South Korea's SK Hynix. For most of July, Bitcoin moved in lockstep with AI stocks. That link just broke, twice. One time is noise, 2 times in 5 sessions is a pattern worth actually watching. Second, a real split is showing up in ETF flows, and this one teaches you something about how institutions think. Bitcoin ETF just posted a 4th straight day of outflows, over $500 million total, led mostly by BlackRock's IBIT fund. Meanwhile, Ethereum ETF just logged their 3rd consecutive weekly inflow. Here's why that matters beyond the headline. ETF flows are basically a scoreboard for where professional money is placing new bets. And right now, that money isn't leaving crypto, it's rotating from Bitcoin into Ether. Morgan Stanley just reinforced that shift too, launching new Ethereum and Solana funds this week with a rock-bottom 0.14% fee and a promise to pass through 100% of staking rewards, no cut for the bank. Third, Bitcoin miners are quietly rewriting their own business model, and this is genuinely useful to understand if you follow mining stocks. Mara's CEO said plainly that electricity earns far more money running AI computing than mining Bitcoin. Translation: mining rewards keep shrinking every 4 years through the halving, but AI companies will pay huge premiums for reliable power and data center space. So miners like Hut 8, TeraWulf, and CleanSpark have all signed multi-billion-dollar decade-plus AI leases. Ionic Digital, a Bitcoin miner spun out of the Celsius bankruptcy, jumped 25% on its NASDAQ debut this week, almost entirely because of its AI leasing deal. If you're evaluating a mining stock today, its AI contracts probably matter more than its hash rate. 2 more angles worth knowing. Michael Saylor warned this week that Bitcoin's biggest threat now isn't external, it's internal fights over changing the protocol's core rules, like proposals to alter block size. His argument, in short, is that Bitcoin's value depends entirely on its rules never changing for anyone's convenience. And Bitcoin developer Samson Mow made a related point about the network's planned post-quantum upgrade, warning that rushing to swap out current encryption for quantum-resistant encryption could actually introduce new weaknesses to today's ordinary computer attacks before quantum computers are even a real threat. Both stories carry the same underlying lesson. Moving fast to fix a future problem can create a bigger problem right now. So here's what actually ties all of this together. Bitcoin is holding up better than expected against both a shaky Fed decision and a brutal AI stock sell-off. That resilience, plus institutional money still flowing in even as it shifts toward Ether, plus miners turning themselves into AI power companies, all points to the same thing. Crypto's foundation is getting less dependent on any single narrative, whether that's the halving cycle, the AI trade, or one Fed meeting. That's usually a healthier place for a market to be, even when the price itself looks shaky. Here's the one thing to actually do with all this today. Pull up whatever crypto or mining stock you're holding and check one number. How much of its future revenue is actually tied to AI contracts versus mining rewards? That single number now tells you more about where that asset is headed than the Bitcoin price does. It takes 2 minutes. and it'll change how you read every headline about that stock from here on out. That's today's Crypto Rundown. If you learned something useful, hit subscribe so you catch tomorrow's episode. See you tomorrow.